Hey, Mike, right here. It's 11 o'clock on Tuesday, September whatever it is, the 19th, I guess it is. And we're starting at 11 o'clock because I must admit that I did have a previous commitment that I had forgotten about when I set up this program. And so I had to put us off by half an hour. But tomorrow, I promise, we'll be back at 10:30 every morning for the rest of the week and for 5 weeks after that. So I hope you find this worthwhile because I think it's important. You'll remember yesterday we talked about the fact that the biggest expense that you have is the things that you don't know. Well, today I'm going to talk about the thing that is sort of the center of my practice, and that is the idea that small businesses are best served from a tax standpoint by setting up their businesses as an S-Corp. Now, this is something that I could spend hours talking about, and I try to keep these events or these talks to about 10 or 15 minutes. So I'm going to be brief on this, but here's what I want to talk to you about. Companies can be organized in a variety of ways. When you first start up a company, you're a sole proprietor. When you very first set up your business, that's what everybody considers you. And as a sole proprietor, everything that company does, whether it's profit or loss, whether it's a tort or a negligence suit, both good and both bad, go directly to the owner of the business. And that means that the assets of that owner are fully exposed for loss. And from a tax standpoint, you're going to file your business activity on your personal tax return. That's what a sole proprietor does. And we file that information on what we call a Schedule C. Now, many times you're advised to set up an LLC. Whoops. That's limited liability company. Hey, look, that's not so bad. I don't write much better than that when I'm not standing up in front of a board. A limited liability company is an entity that if you set it up, then the liability of that business activity is isolated within that business. However, if you're a single member LLC, from a tax standpoint, the IRS still considers you a sole proprietor. So, single member equals sole proprietor. If you're a multi-member LLC, the IRS considers you the same as a partnership. Why is that important? You're still getting the limited liability protections that you set up this business for, but from a tax standpoint, you've cost yourself money. And the reason for that is this: both the sole proprietor and the partners in a partnership, their share of the company's profits pass through to them as ordinary income. In other words, they pay not only the income tax on that income, but they also pay what's called self-employment tax. Now, you may know if you're an employee, you get a withholding from your paycheck for Social Security and Medicare. What you may not realize as an employee is that your employer pays the other half of that Social Security and Medicare tax. So if it's self-employment, you pay both halves of that. And that self-employment tax amount in total is 15.2% of your profits. 15.2% of profits. (15.2% of profits. Of course, plus income tax, which goes through the various categories that income taxes do depending upon your total income. But whatever your total income is, 15.2% is taxed as self-employment tax. Now, what can you do about that? What's that look like? Let me show you something about that. I'm going to turn the page here if I can get the page to flip. Let's say you make $100,000 in profit in your small business. If your small business is a sole proprietorship, or if it's a partnership, then whatever the amount of that profit that you receive, we're going to use 100,000 because it's easier to divide it up. If we had two partners, it'd be 50,000 apiece. If we had three partners, it'd be 33.33333 thousand apiece. You get the point. But that $100,000 in profit, there will be income tax on that, which will be somewhere, the marginal rate on that will be somewhere in the 20% range. It depends upon exactly how much the marginal rate is because of the cutoffs. And of course, if we're talking about 2023, the cutoffs are different than they will be in 2024 and so forth. That's the regular income tax. But on the self-employment tax, over and above everything else that sole proprietor owes in taxes, there will be a $15,000 tax owed on top of that. $15,000 in tax. That means that the profits of the company are really only $85,000 because this is there's no deductions, there's nothing, all those have been taken. We're talking about profit. So all of the expense deductions, all the things that can come off, this is the profit that's left. This is the tax that will be paid. What can you do about it? If you have your company set up as an S-Corp and pay yourself a reasonable salary, you can cut the amount of the self-employment tax substantially. Now, not to get too deeply into the weeds here, but two things I do need to say. You can either set up an S corporation from the start, or you can tell the IRS you want to have your LLC treated as if it were an S Corp. Either of those factors will provide you the benefit I'm about to describe. We'll save for another day my explanation as to why I do not believe that being treated as if you were an S Corp is the best way to go, but that's for another day. So if you're an S Corp and you pay yourself a reasonable salary, here's what happens. First off, what do I mean by reasonable? Well, reasonable is going to depend upon the size of your business and the kind of business that you have. There is no fixed amount that the IRS requires to call reasonable, but there is an amount that you can decide that you want to use. Typically, how we define a reasonable salary is what a person doing what you do as an employee would be paid. So if you're an outside salesman and you make a certain amount of money and you receive that as a salary, that's what we use to create your reasonable salary. But we can also modify that with the idea that as a startup business, you have a great deal more expenses to pay to get that business going, and the amount that you may want to take for a salary is a lesser amount. For a very small business, maybe one not making $100,000 in profit, you might even be able to justify not taking a salary at all during the startup years of your business. But let's look at it this way, and this is the example I like to use. If you start your business at $100,000 in profit and you pay yourself a $25,000 salary, that might be perfectly reasonable under many circumstances. But if that business grows and then becomes a $5 million business, and you're still only paying yourself a $25,000 salary, that's not reasonable at all. And that's the kind of thing that the IRS will look at if they look at it. But let's just look at something here that really makes a lot of sense, and it's easy to figure out in your head, and it illustrates what I'm driving at. Let's say as an S-Corp, you pay yourself $50,000 a year in salary. The salaries of employees are an expense, and therefore they reduce the profit of the business. So if you pay yourself a $50,000 salary, you still have $50,000 in profit. Okay, same scenario, $100,000 total, 50 salary, 50 in profit, 15. What's the net effect? The net effect of this with regard to income tax is the same. And I don't want to go into details as to why, but it's because the profits that you receive are a pass-through from the business to the individual. And so the tax rate that the individual pays is going to be based upon the total income of that individual, not on the profit of the business. But for the business itself, the profits are determined by what comes in and the expenses that they pay. And now the salary that you take is part of those expenses. So your profits are less. From the standpoint of the S-Corp itself, here's what that means. You'll remember that up here, when you had $100,000 profit, you paid $15,000 in self-employment tax. And that's because the profits of a self-employed person or the profits share of a partner are taxed as ordinary income. In the case of a corporation, the salary received by the principal of the business is what is taxed for Social Security and Medicare. It's still the same 15%, but it's 15% of the salary, not 15% of the total profits. And that's divided in half. Let's see, 15%, that's $7,500. The total is $7,500. What is that? $3,750 in withholding and $3,750 in expense. The business pays the $50,000 salary. The business also pays the $3,750 in Medicare and Social Security taxes for this employee, the employer's share of that employee. The employee has the $3,750 on their share taken out. The matter of the fact is $7,500 is the Medicare and Social Security tax, the employment tax that is owed by the individual. How much employment tax is owed on the profits? Zero. There is no employment tax on the profits of a corporation. So in this simple scenario, you have saved yourself, your business, however you want to look at it, you've saved yourself $7,500 without doing anything else but filing a few papers with the IRS every year. Now, as I said, this is a situation that I can get kind of deep in the weeds on and talk about more and more. But for right now, this is what I'm driving at. I have set this up for a large number of businesses that I work with, clients of mine, and savings of $8,000, $10,000, $15,000 the first year are not uncommon. And we can look at your situation and see how this works out for you, because it's an important way for you to be able to deal with these taxes. Taxes are a big expense and they have to be paid. And if you can control those taxes, it's a perfect way for you to make your business more profitable. That's what the Red Shoe Business Club is all about. We're trying to teach you things that can help you make more money out of your business. You're in business to make money. You're also in business to help people. Well, if you're helping people better, then you're going to make more money. And if you make more money, you need to save more money on your taxes. And that's what we're trying to do. I will announce that the projected date is November 1st, but I will be publishing a book entitled The S-Corp Revolution, which will talk about this issue, and we'll talk about all the other details more carefully. We'll also use this as a topic for some other Facebook Live presentations. But for today, that's it. I think the 20 minutes that we've spent here today, the 15 minutes we've spent here today, is probably worth $7,500 to you. And all you need to do is to sit down, think about how to make that happen for your business, and I'll be glad to help you with that. Or you can consider joining the Red Shoe Business Club and learning more about this and more about other ways that your business can work out the best way possible. So for today, tomorrow at 10:30, we'll get together again. But for today, that's it. Have a good day. Take care.